Hello guys, and glad to have you on board again. Today there are significant updates, enough at least to make a daily update today, and we're going to have to talk about the 10-year yields looking for a rock bottom area, and as of right now we might have suitable signals as we try to test the trend channel. So we have oversold markets in a bullish cycle, which means normally we're supposed to find some support out there. We're going to study technicals within the next few days and weeks, as we are currently looking at a weekly chart. Means it can take another couple of weeks before actually finding this bottom area. Technically speaking, we have an easy target to go for, which is by just joining the previous low points. We can see that there's still a little bit of room to the downside, but still, considering it that way, that this trend line, whichever technically it could be, basically just doesn't mean any fucking thing but the fact that we're dealing with the same level, price level, which is basically trying to dip below 1.40% for a 10-year yield. So we're trying to get below once again. We're currently trading 1.28. Big question is, first of all, are we going to succeed maintaining a weekly candle close out there, or is this just another smoke screen that we're gonna easily fuck about and rebound out of by next week? This is still a hard question to answer because, like we stated, we're already oversold, and the question is, are we going to deal with a strong rebound on the trend channel? There is this horizontal level supporting these price areas as well, and the fact that the current momentum is by far supported by the bulls. So we'll see all about that, but this is definitely a question mark. In my personal opinion, to make it straightforward, there has definitely been a major market bottom built out there due to the COVID pandemic, exceptional situation, a situation that we will never ever get back to. But of course, as usual, people tend to say that the massive move is this one and therefore there is a bear trend. Well, guys, there is something that you might be forgetting about. This is just not another stupid chart that you're looking at. This is just bond market. This is driving billions of dollars each and every day, and this is basically one of the most liquid and impossible to cheat market. Even though, of course, the Fed is trying to cheat on this by manipulating the yield curve, it simply isn't working as expected. The reason why is that we see a lot of distortions out there, not to mention the heavy amounts of reverse repo on short-term yields and stuff like that. So it is basically meaning that we have hell of a trouble with pricing risks in the bond market. And I tend to believe that this is just transitory. This is by far more transitory than the inflation is likely going to be. But still, the thing is that you never cheat with the bond market. This is where the smart money park the cash when they arbitrage against stock market and other riskier asset classes. So we need to understand what the fuck is going on in here, because I think that anyhow and anyway might be a lot of things happening in other asset classes, but this one is the one that holds the key to the future cycle's direction. If you ask professionals, they will very likely tell you that, just like I think, we're going for an inflationary cycle. The thing is that inflation doesn't necessarily mean growth, and this is where I think other set of institutional and professional traders kind of point to a weird type of cycle that economic guys tend to call stagflation, in which we're going to have high unemployment numbers. I mean, definitely not the ones we've had through COVID, but normally we're bottoming out of 10% unemployment, and we can hardly go below these levels, structural unemployment, due to distortions of supply and demand. So this is exactly what we're having right now, and we see the tipping top of the iceberg, but I think we're going to sooner or later figure out what's really beneath the surface. And what might be looking, what it might look like in terms of market participant behavior should very well look like stagflation-like trades. And in stagflation, we stated that the job market isn't as healthy as it might be expected to be. The inflation generally rolls out of control, but still isn't going to hyperinflation territory either. So the hyperinflationary trade is simply not going to make it. Just like the recovery trade isn't going to make it, stagflation is kind of a weird in-between mix. And that's by far what I think is the likeliest outcome in the next few years. We've anticipated inflation that will definitely be there, but just not to a point that people are pricing it now. We've priced the recovery and we're definitely not going to get it the way we think it is. But the thing is, we might see, I think there's one trade I'm definitely so confident about, is the fact that anyhow and anyway, yields will increase within the next few years. There's not even a chance it can go on the other way around, because the Fed might be trying to do anything they can. They are just fueling over speculation, and sooner or later, they're going to have to put on the brakes. They will have to taper, they know it, they will have to increase rates to send the message. It will very likely crash the market. Yes, they're pretty much aware of this. This is a game that has an end, because it's inevitably going to be that way. The question is, we definitely don't want to be the person who triggers a market crash, so they definitely try to push it away, further away in the time, but we all know it's inevitable, because otherwise we're going to get excessive liquidity parked into very dangerous speculative areas, meaning that anyhow and anyway, it will crash. Because if you park some dumb money into very speculative sectors, it drives over speculation, and at some point it just bursts all itself. It's the craziest good old Ponzi scheme. When everyone is parking into the same area, at some point the last stupid guy to buy the market top is just going to cause a market top that generally reverse, and then people figure out that they might have made some bad choices. They try to put the money out of the game and no one's there to buy. It's really that kind of trouble we're heading to if there is no taper. So taper might cause the market to fall off the cliff, not to an end of the world kind of territory, just the kind of things in which yields were severely increased, which can no longer be positive for the stock market. Okay? You need to understand that yields have to price in both inflation and growth, economic growth. So the thing is that in stagflation, we're going to get a higher inflation than the growth. And that doesn't mean that we get no growth, okay? It's really not that type of things in which we print our way out of recessions. This is what we've done. This is not what we're into now. The recession is likely going to be over, but the growth isn't going to be as expected, and certainly not enough to compensate for the debt we've created, and this will likely create high levels of inflation, but not out of control or inflation. Think of it as something like 5 to 6% year inflation with a growth that is going to be below 2%. So less than 2% growth with 4% inflation can no longer be rising, bearish for yields. It's just not going to happen that way. That's what we've had previously because we had very low level of inflation. We actually had deflation or hidden deflation over the latest few years. And the economical growth has been slowing, which has been pushing yield down severely, much more because we had very accommodative monetary policies. This is no longer going to be the case because monetary policy has been the center of the maze for quite a decade. It's not going to be the case anymore. Right now, economical data is what's likely going to drive yields, and whether the Fed like it or not, they will lose control of the bond market pretty much sooner rather than later. But we're talking about some year-long trade, something that will generally ripple out from 2021 up to 2025. I'm not a magician, so I goddamn don't know how long it's going to take. All I know is that we should see early signs of my scenario's validation out of the current areas. So definitely bearing in mind that the current price area on 10-year yields is crucial to either validate or invalidate my personal scenario. I'm no god, and I can damn be wrong. I just doubt I will. Okay, other areas of the market needs to be assessed to understand the full grasp of what's going on. It's really all about the volatility sector as well. Lots of speculation, derivative speculation, most importantly, puts and calls, the Robinhood traders who think they might be on the verge to reverse the market course. I mean, they definitely found the golden door that you can just make easy money with betting on puts and calls until the day you will be fucked up with enormous amounts of volatility. That's great to gamble gamble when liquidity is irrationally being put into the same markets, but when, of course, the trade ends, you're going to suffer huge and irrational volatility levels. So, of course, the thing is that people are margin trading, using puts and calls and whatever derivative applications on their cell phones. That's great. Okay, great. You guys can teach me my job. I don't think. I think I will teach you yours at some point, and how to get back to your regular jobs after quite a nice period of time dealing with Robinhood applications and trying to teach me what my job is. So the thing is that the markets are complicated. They've always has been. And now it looks like some people are trying to teach me how easy trading is. Well, good job and good luck with that. It's likely not going to last very long. Until then, I hope volatility will very likely show us early signs of going back to normal, meaning that we stop with the derivative bullshit and we start to rise back into some more complex trading perspectives, because that's definitely the world we live in. A complex world, so easy answers to complex easy solutions to complex problems is definitely not the way the market generally trades. So we'll eventually get to see actions of it. Early signs are actually going on right now. I have been piling some bearish positions into the stock market within the latest few hours, and I'm definitely looking for validations this time. We'll see all about that. Just to make it plain simple, we're having a bit of volatility. We're bearish engulfing at the current given time. Weekly candles are signaled after trying to accelerate, so we're trying to trend breakout into this thing. Do you really think the trend is going to break out of this? I remember that trend breakouts occur when you get out of a mature range, which we definitely do not now. So I think more than anything else, it's the stupid crowded trade I've talked about into the weekly updates. Everyone's going in because they think it's never going to go down, which is as stupid as it can definitely be. So I think that this is the appropriate time to get a pullback, minimum 23%. So the bare minimum to get to buy is 3,800, which I think we're very likely going to drop down to 38 or even possibly lower than that. 50% will drive us right back to 2020 open, which is still freakingly bullish over the midterm. So if you're among the guys who think that we're going to crash out and the end of the world, whatever, this is just not the likeliest outcome. Despite that, are we going to get a huge dip and a burst of volatility? I think we very likely will. I mean, there's way too much speculation, and we've said that there is an inevitable readjustment of the bond markets. If I am right, and if we're heading to stagflation, means most of market participants are currently trading the wrong direction. And if they are, that means they're gonna have to suffer invalidations, which means I think volatility is the way to put them out this game. They're all derivative trading with puts and calls, mostly puts, mostly calls, and they're mostly calling into the big names, reason leading me to believe that there is hell of a trouble down the road for these big names. But still, that is my experience, sixth sense, that's telling me not to get into those crowded trades. I've warned you about that, but going into reverse trading, meaning selling the guys who are buying, is not the easiest way to do things. Just not going to follow is what I like you guys to do, okay? Though despite that, all of the technicals suggest that if we have daily confirmations, or at least validation, meaning I'd like to see prices reaching out the trend channel, that is going to be the sign for me that the end is here. Though these signals that we're currently experiencing are with the live candle, okay? The algorithm is detecting the context. We have the same daily breakout structures. So everything is green light for reverse trading. That doesn't mean it will work out. I've seen multiple of these contexts back in the days, and they all have failed. This one worked, but I got fucked with the sectorial rotation. I got damn hope that this one's going to be the right one, but I damn don't know. So you have to be cautious, you have to be patient, and most importantly, don't ever enter a trade that you don't know anything about. Reverse trading is far more complex than just waiting for this. It requires a lot more derivative lectures of the market, volume volatility, and lots of other anticipated signals. Though these things that you mostly don't know how to do must not be done unless you do, okay? And most of you guys simply do not. So that's for the stock market, okay? So watch out for the bond market's reaction until we have a clear and clean closed candle in here that shows a bit of volatility, a beginning to see a trend emerging either one way or another. At least if we see a reversal on the WTI that is confirmed, which we have early signs of today, and if we see a confirmed reversal on the 10-year yields bottoming into the daily and then confirming it with the weekly candles, then we'll be confident enough to say that we have a market top. And when I'll let you know when you can trade all of the probable third range boundary retracements we'll get. Okay, so as of right now, it is a reverse trader opportunity, nothing you want to take part of. Okay, so crypto market now, because that might be the next question you guys are going to ask me. If the stock market falls off the cliff, what's going to happen with the crypto market? Are we going to go into this area? I doubt we will, for a simple reason. We have no such a thing as a correlation right now. The correlation has been existing for a little while. It is, I think, going up over time and is increasing its strength of correlated market classes, but still we have a huge decorrelation factor in here, in which the stock market has gone steadily, slowly but steadily upward when we had a falling off the cliff crypto market. That means that supposedly correlated assets have gone into opposite correlation temporarily. Generally means they will correlate again, and the recorrelation phase takes on with a bit of statistics. We've talked about that in the past in the live room sessions, though if you don't know anything about it, you can catch the replays into the Discord eventually. Otherwise, I'll give you the bit a bit of information that is what you need to assess. Generally, these patterns on the recorrelation takes a faster recorrelation to a point that is generally going to follow the strongest move. So in here, I supposedly think that we're going to get exactly the opposite, a slowly but steadily rising crypto market when we'll get a falling off the cliff stock market. And when they both recorrelate, the next cycle is a big fucking question mark. Are we going to get an upside move reaction or a downside correlated move afterwards? Are we going to get a crashing market into the stock market because the crowded trades post-COVID will definitely invalidate, and we're going to have some severe losses in the crypto into the stock market, but this time the crypto market will follow accordingly, both losing hundreds and hundreds of millions in market caps. Or otherwise, we're going to get to the same old thing. When people get to panic, we actually buy the dip because it's not the end of the world. We've got significant pullbacks, huge losses for those who were buying the market top, and of course, huge opportunities for those who were patient enough, like me, to wait for the dips to show up. And in that perspective, I think the same old V-shaped reverse are the likeliest outcome, likely both the crypto market and the stock market. So this is what I think about these markets now. I'm no future teller, but this is what I trade. I've tried to explain at least the ground basis of technical supporting these patterns. That doesn't mean they will show up. All I'm saying now is that I see a red flag on the stock market today. I'm waiting for daily candle closes to confirm. Until then, reverse traders patterns. I'll let you know if we validate them. But until then, just don't be dumb enough to jump into a trade that you simply can't handle. Okay? As of for crypto market, if you're selling because you think it's going to go off and so on, just Jesus fuck, there's not even a reason to sell right now. We're just consolidating, and like we stated, we're not even yet into resistance territory, so selling in support is just dumb as hell. Bye guys.